All right, today we are diving into one of the most powerful and honestly one of the most misunderstood concepts in all of trading, divergence. I'm talking about a tool that can seriously feel like you're seeing the future. But, and this is a big but, if you use it wrong, it's a trap, a nasty one. So let's break down how to actually use it the right way.
So let me ask you this. You've been there, right? Watching a stock just rocket up, but you've got that little voice in your head saying, this can't last. What if you could get a real concrete signal that the top is just around the corner before the price actually falls off a cliff? Well, that's the incredible promise of divergence.
And look, this isn't just some textbook theory. This is what the pros are doing day in and day out. They use divergence to see those market turns coming and get in position way ahead of everyone else. It's kind of like their secret weapon for catching those huge trend shifts right at the very beginning.
But here's the catch, and it's a big one. For every single pro who nails it with divergence, I guarantee there are dozens of beginners getting absolutely crushed by it. Why? Because they see a signal, they get excited, they jump in way too early, and then they get steamrolled by the very trend they were betting against. So the big question is, how do you use this incredible tool without falling into that exact trap? Well, that's exactly what we're going to figure out today.
Okay, first things first. What in the world is divergence anyway? It sounds all technical and complicated, but trust me, the main idea is super simple. It's really all about looking for one specific disagreement on your charts.
So, at its heart, divergence is just a mismatch. It's when the price of an asset is doing one thing, let's say it's pushing up and making a brand new high, but your momentum indicator, like the RSI, is doing the complete opposite. It's making a lower high. That disagreement, that disconnect, that's your signal. Think of it like a flashing yellow light at an intersection. It's telling you, hey, slow down. The power behind this move is fading, and this trend might be running out of gas.
Now, there are actually four main types, which you can see broken down right here. Most people, they only focus on the regular ones. Those are the ones that hint the trend might be about to reverse. But check out the hidden types. These are sneaky. They actually suggest a trend is going to continue. Now, you need to know about all four for sure, but for today, we're going to focus on mastering those classic reversal signals first.
Okay, so if it's really that simple, just spotting two lines going in opposite directions, then why on earth do so many traders lose a ton of money trying to use it? Well, the answer comes down to a few really common and really costly mistakes.
So let's just rip the Band-Aid off and break down the 5 biggest traps that turn this powerful trading tool into an absolute money pit. Yep, here they are. Reading the signal wrong in the first place, getting completely fixated on those lower time frames, not waiting for any confirmation, having absolutely no risk management, and chasing after every weak little signal that pops up. It sounds bad, I know, but don't worry, because we're about to take every single one of these traps and flip it on its head to create a rule for success.
All right, now for the good stuff. Let's actually build a solid, simple framework for trading divergence the right way. We're going to boil all this down to just 3 very powerful and actionable rules. Okay, rule number 1, use higher time frames. Seriously, this is all about perspective. Trying to trade divergence on like a 5-minute chart, that's like trying to figure out the ocean's tide by just staring at one tiny wave. It's impossible. You have to zoom out to see the bigger picture. I mean, just look at the difference here. On the left, you've got the total chaos of a low time frame chart. It's just a mess of noise and false signals. But on the right, the daily chart filters all of that nonsense out. You get clarity. A divergence that shows up on a daily chart carries so much more weight because it's showing you a real shift in the market, not just some random short-term blip. And hey, don't just take my word for it. There was a study in the Technical Analysis of Stocks and Commodities magazine, and it found that traders who used multiple timeframes boosted their win rate by a staggering 27%. Think about that for a second. Just by zooming out, you're giving yourself a massive statistical edge over everyone else. Which brings us perfectly to rule number 2. And honestly, this might be the most important one of all. You have to get confirmation. A divergence signal is just a hint. It's a clue. It is absolutely not a command to go and slam the buy or sell button.
So, how do you know the difference between a weak little hint and a really strong signal? Well, you look for a few things to line up. A strong signal shows up on a higher time frame. It has a really clear, obvious gap between the price and the indicator. It's backed up by high volume, and, this is crucial, it happens near a major support or resistance level. Your job as a trader is to learn to ignore all the weak little whispers and just wait patiently for these big, loud signals.
So what does this confirmation actually look like on a chart? Think of it as a second piece of evidence that agrees with your theory. Maybe it's the price breaking through a key moving average, or maybe you see a MACD crossover finally happen. One of the best forms of confirmation is just a classic candlestick pattern, like a big, powerful engulfing bar. When you get the divergence signal and then you get one of these confirmation signals, man, your odds of a successful trade just shoot way up.
And that brings us to our third and final rule. This is the one that keeps you in the game long enough to actually make money. Because no matter how perfect a trade setup looks, it can still fail. You have to remember, your number one job as a trader isn't to make money. It's to protect the money you already have.
Think of risk management like a three-legged stool. You need all three legs or it all falls apart. First, you always set a stop loss. If you're looking for a bullish reversal, you stick that stop just below the recent low. Simple. Second, you got to use proper position sizing. That 1% to 2% rule, it's non-negotiable, period. And third, you only take trades where the potential reward is way bigger than your risk. If you can't get at least a 2-to-1 reward for your risk, just let it go. Walk away. I promise there will always be another trade.
Okay, we've covered the basics, we've talked about the traps, and we've laid out the rules for success. So now let's put it all together into a dead simple, step-by-step checklist you can use on every single trade.
Here it is, boiled down to 4 critical steps. Step 1. Spot a clear divergence on a high time frame. That's your alert, your heads up. Step 2. Wait patiently for that confirmation signal. That's your green light. Step 3. Plan the entire trade. I mean your entry, your stop loss, your profit target, all before you risk a single penny. And finally, Step 4. Execute with discipline and stick to your plan. This systematic approach, this is what separates the pros from everybody else.
And that entire checklist really boils down to one single massive idea, probably the most important takeaway from this whole thing, and that is understanding the huge difference between a signal and a confirmation. I really want you to burn this into your brain. Divergence is a signal to pay attention, not a signal to act. Think of it this way. A divergence is the market just tapping you on the shoulder and whispering, hey, you might want to pay attention over here, something could be about to happen. It is not the market screaming in your face, sell the house and go all in. It's a tool that rewards patience, not impulse. And that right there is the final question, isn't it? The divergence gives you the signal to look, but the chart, the confirmation, that tells you when to leap. That space in between, that waiting period, that's where almost everyone fails. They just don't have the discipline to wait for the market to prove their idea is right. So do you have the patience to wait for that proof? Because that is what separates the pros from the crowd.